What's price doing? Are we seeing momentum divergence? Is there some exhaustion in price as we get into that level? The misconception that I need to figure out the market is something that a lot of traders struggle with. The market is always right, bottom line. We are just looking to take advantages of little opportunities that the market's giving us. When we recognize these patterns, when we recognize these key thresholds in price, it allows us to take that opportunity. You're never gonna catch the low, you're never gonna catch the high. Accepting that is your first part of being a trader.
Echo, play business news.
So I wake up. The funny thing is, most people find funny, the first thing I do is just turn on it. So I'm just hearing, Bloomberg or CNBC, whatever. I don't really care what they're saying. I just want to know if anything happened overnight. Was there anything in Asia? Was there anything in Europe that I need to be aware of? Then it's just look at what the markets are doing price-wise, get ready, hop on to work. And then throughout the course of the day, I have alerts. I have specific levels I'm looking at. If the market hits that level, I'll see how price action's reacting. Maybe I want to jump into the trade, maybe I'm not. But the biggest misconception or the biggest thing I try to stay away from is people say, what's your daily target? How much you're looking to do a day? How many trades you're looking to take a day? That's completely based on what the market's giving me. There are days the market won't give me anything. There are days I'll be 10 trades deep, on a single session. It is completely dependent on what price does and what the market does. So setting unrealistic expectations of what I want, that doesn't matter. If the market's there and there's 15 trades today, great. If a week goes by and I can't find a single opportunity, that's the business we're in. On the ferry, on the commute, I'll check some charts, but really it's the transition from the European markets into the US Open, that's like my sweet spot. So in that crossover is where usually I'll either enter a position, or a lot of times if I've been in a position from overnight, that's when I should be closing the position. Risk management is one of those things that tends to be underplayed a lot. A lot of people say, oh, you need to have a risk to reward ratio of 2 to 1, right? That's what they work with, but that's just part of it, right? You can have a risk ratio of 2 to 1 and still make a mess of things because your entry's off, your exit's off, where you're looking to execute is off, the time you're looking to execute is off. There's a million things that could be off. For me, the biggest thing with risk tolerance is judging the conviction of the trade. So there are trades where there's a lot more factors, technical factors in favor of that trade. There's a lot more fundamental factors in favor of that trade. Those trades, I'll tend to be a little bit more dynamic with leverage. And the one thing about risk management is a lot of people tend to downplay leverage. It's a big part of it. It's not just this is my limit, this is my risk. No, it's a lot has to do with the amount of the position that you're putting on. Are you scaling in? Are you scaling out? So for risk tolerance, it has to be sort of an encompassing whole, more holistic strategy. It's not just, I'm working with a 3 to 1 risk to reward.
Okay, hey traders, welcome to this live weekly strategy webinar. Michael Boutros with you this morning. Great to be with you guys. On the menu for today, we have a whole list of trade setups to review. DXY, Euro Dollar, Dollar CAD, Gold, and the SPX. As always, if you have any questions or trade setups, feel free to throw them on the message board at any time. Let's jump right in.
My strategy is very technical analysis based. So all of my focus is on what price action is doing. So there's two major disciplines, obviously, that everyone knows about, is the fundamental side and the technical side. For me, the technicals are fundamental. That's what I'm trading. I'm not trading central bank policy. I'm not trading what the interest rate outlook is. I'm trading what that's gonna do to price. So for me, when I'm getting into a position, the only thing that matters is what price is doing. Everything else is noise. Now, does that mean that you completely discount the fundamentals or ignore it? No. You obviously need to know when the announcements are coming out. You need to know when these major economic events happen. But for me, I just want to be in front of the computer when it's happening. I have a bias on the market. I have limits, stops, specific targets I'm looking for. The noise that's coming is just going to spark volatility. It's not going to dissuade what my thought process is. It might invalidate it if it pushes price to do so, but my focus is on what price is doing. So I try to keep them separate. I'm always aware of what's happening on the fundamental side, but for me, trying to forecast what NFP is going to be on Fridays is a fool's errand, right? I want to know what my focus is, what the trade I'm looking for is, and let that noise prompt the action in price. It's pretty much my take. Technical analysis is one of those things where there's not one right way, but there's a million wrong ways. So there's a lot of different disciplines. Some people are, Ellioticians. I use Elliott Wave. I go to Elliott Wave Church every Sunday. That's my indicator. Some guys I use rate of change. The point is, whatever you fall in love with, stick with it and really study. The biggest thing with indicators is that they're all backwards looking, right? Nothing's telling you what's gonna happen. They've all told you what has happened. But by recognizing how a specific indicator reacts to different pricing conditions, you can really use it to your benefit. So my major tools in technical analysis is slope analysis or trend lines, basic trend lines, Fibonacci is something I work really aggressively with, and momentum. So for me, it's about finding key levels of confluence where a lot of technical indicators are lining up. Might be a moving average, might be a pitchfork, might be a Fibonacci region, and using reaction to those levels to my benefit. So if we're in an uptrend, obviously we're looking for those key levels on the pullback where markets will find support. On a downtrend, same thing. On a rebound where we might find a resistance to jump back in. But it's all based on what price action is doing and not just lateral levels. A lot of people I tacked on a Fibonacci retracement. This is a 618, that's my target. That's me using Fibonacci. That's not the way it works, right? If it was that easy, then everyone would have done it. So my specific brand of technical analysis focuses on regions of confluence, where those technical indicators are all lining up. So whether it's a moving average, a Fibonacci level, a median line, a major high day close or low day close, those key levels in price, I look for the market reaction against those levels. So obviously if we're in a strong uptrend, we're looking for that pullback where we should find support. Same thing on the downside if we're in a downtrend, but the most important thing is how price is reacting, not just the lateral levels. So when we get to that region where I'm expecting reaction, what's price doing? Are we seeing momentum divergence? Is there some exhaustion in price as we get into that level? Those are the opportunities sort of line up.
All right, Feds, 5 seconds. Interest rate hold. And removes gradual increases on interest rates moving forward. Should be dollar negative.
I'm a big believer in multi-time frame analysis, so I always have my weekly charts as sort of a guide. I know what the markets are doing, what the trend is, where I am in trend, and then we zoom into the tighter time frames for actual execution. So I'll use a 2-hour chart or a 1-hour chart to map out the levels, and for actual trade execution, 10, 15-minute charts, really get deep in to maximize your entries rather. Just to time things a little bit better, you need that tighter time frame. But if you're trading blind without the broader picture of what's going on, it's, again, bad road to go down. Just because you're executing on a 15-minute chart, it doesn't mean that's a time frame for the duration of the trade you're gonna be in, right? So when I put the trade on, you have your limit, your entry, you have your stop, and you just let it go. I'm not the kind of guy who will sit there and stare every single second waiting for every tick. Now, obviously there's times where you want to fade out of a position, so I might have gone in a little bit heavier. As we go through the targets, we'll shave a little off, bring your stops up, being a little bit more protective. But in general, it's a good rule of thumb to put the position on. If you have good risk management and you have sound strategy, let the market do what it's gonna do. A lot of times watching or market, babysitting a trade, as it were, can lead you to make some decisions that you wouldn't normally make, because that's when the emotions start to filter in. So to be as objective as possible, I try to just let it go once I have it in. Specifically because I'm a near-term trader, it allots me that flexibility when I go on holiday to not look at the markets. I don't have to be. I'm not married to a position. I'm not married to a bias. I don't have to be involved. Now, that rarely happens, because when I am on vacation, I got one eye on the phone at all times, and it's not always the best thing to do, but those possibilities are always abiding, right? So there's times where, yes, I unplug, I go on vacation, I don't want to know what happens in the markets, and when I come back, there's so much excitement and so much to look at that there's opportunities all over the place. So there's ups and downs in both, but for sure, I definitely try to dictate a time where, I'm stepping away from things. When I get home, first thing I do is right back. Maybe it might be a little overkill for my setup at home, but I typically will have 5 screens. One of them will have a new financial news publication wire just running in the background, so if there's any news, I can learn about it quick. In today's universe, the Twitter sphere is unfortunately a needed evil to know what's going on, like quick. First thing hits usually on Twitter before even the financial news publications get it, oddly enough. And then the other screens are charts. One's one trading platform, the other one's charts. Usually I have a daily or a broader encompassing chart, and then the same asset that I'm trading, I'll have the smaller time frames. So it gives me flexibility to see, okay, well, we're not there yet. When the longer term trend reaches this level, here are the levels I want to operate on. So it might be overkill, but a lot of it's mostly for news, for major headlines that are hitting right now. I want to know what they are. And indicators as far as alerts, when price action is reaching a certain level that I need, or whether it rings on my watch or whether it rings on my phone, I'll be alerted. The biggest mistake I ever made was thinking that the market couldn't possibly go any further. I'll tell you an example. I was one of those guys who fought dollar yen from like 130 down to 70. The entire way it's coming down. I was early in my years, and I was so confident. This is support. This can't break. What are you talking about? No, this is the buy of the century. And as you're compounding into that losing trade, you can really make a mess of things. And the old adage that everyone always says is so true. The market can stay irrational way longer than you can stay liquid. So that was a lesson that hard learned, costly, but I think that singular event sort of changed my whole outtake on what I'm trying to do in the markets and my approach to trading. So the biggest lesson I've learned in trading is to never stop learning. If you visit my strategy 8 years from now to what I'm doing now, there's a stark contrast. It's because over the years we've filtered in some added addition of different techniques that have worked, and we've segued out some maybe techniques that aren't working in this environment. And so people fall in love with a specific strategy or an indicator or a specific technique, and they kind of get fixated on that. This is the way I trade, work or not, win, lose, or draw, that's what I'm doing. Trading's got to be, you're constantly adapting. You're constantly taking in new information, seeing what's worked, what hasn't worked, recognizing the vulnerabilities of certain strategies or indicators that you're working with. So, a popular misconception, momentum or RSI is in overbought territory, 70. It's a sell, right? Biggest misconception in the world. Because actually when the market's breaking into overbought over 70, that's when it has the most thrust behind it. So always learn. Always be able to accept the fact that maybe what you're doing may not be the best way. Maybe there's another thing you can add to fine-tune your entries or your exits. Don't fall in love with one strategy. The advice I usually give people is, study your personality first. There's people who come to me and they're like, hey, Mike, I'm really interested in intraday trading. I want to be a near-term trader, but that's not their personality. Trading is a very personal thing. There are some people who are comfortable jumping into a position and sitting in that position. Days, weeks, months, doesn't matter, There are guys who want that immediate thrill. I want that immediate feedback. Those tend to be a very risky attitude to trade with, but they don't want that exposure. I do not want to be in a trade where I have open exposure to markets for days or weeks on end. You have to recognize what suits your trading style best. And for me, that took time. A lot of times at first I thought it was swing trading. This is what I want to do. I want to work exclusively off daily charts. I want the bigger picture trades. It wasn't my style. So first thing to do is recognize what kind of strategy you're going with. Are you a guy who's trading off of fundamentals? You're looking for the broader picture, or are you a guy who's trading off of price action? If you're trading sheerly off price action, trade off price action. If you're trading off of fundamentals and a longer term macro picture, you shouldn't be looking at hourly charts, right? You've got to have a lot longer time horizon where you're willing to sit in that trade for a lot longer of a time period. So recognizing what your personality dictates as far as a trading strategy, I think is the biggest thing. And then from that, it's just governing emotion is the biggest thing. You have to really be able to, ideal scenario, we say we turn into robots. That obviously never happens, but stripping emotion out of it is the single most important thing a trader needs to do. Hi, and thanks for watching. If you want to learn more about trading and how to master advanced strategies and tools, join the IG Academy. And for more daily business news updates, subscribe to our YouTube channel, IG UK.